Hello all, welcome to the last session of the Unit 2 Financial Decision Analysis. In this session, I am going to talk on the methods of the lease financing, sales, direct leasing, and leverage leasing. So, lessors use three primary methods for obtaining assets to be leased. The methods depending largely on the desires of prospective lease. The methods are sales and leaseback, direct lease, and leverage lease. So, let's discuss all these types one by one. So, sales and leaseback. Lessee under which the lease a lease under which the lessee sells an asset to a prospective lessor, then the lessee back to the same asset, making fixed periodic payment for its use. Usually, the asset is sold to approximately its market value. The firm receives the sale price in cash and the economic use of the asset during the basic period. In turn, the contract to make periodically lease payments and give up title to the asset. As a result, the lessor realize any residual value the asset might have at the end of the lease period, whereas before this value would have been realized by the firm. So you can see the lessee. Okay, he's making the lessee is making the agreement with the lessors. Okay, so sales and leaseback. The firm may realize an income tax advantages if the asset involves a building on own land. Land is not depreciable if owned outright. However, because lease payments are tax deductible, the lease is able to indirectly depreciate the cost of the land. Lessors engage in sales and leaseback arrangements include insurance companies, other institutional investors, finance companies, and independent leasing companies. So let's sales leaseback. So landlords is tenants is making agreement with the landlord. So landlord and the seller is the tenant and the buyer of the property is the seller. Under direct leasing, a company acquires the use of an asset it did not own previously. A direct lease can be defined as any of lease transaction which is not a sales and leaseback transaction. In other words, a direct lease, the lessee and the owner are two different entities. A firm may lease an asset from the manufacturer such as IBM lease a computer. Indeed, many of capital goods are available today on the lease financial basis. The major lessors are manufacturer, finance companies, banks, independent leasing companies, special purpose leasing companies, and partnerships. For leasing arrangements involving all but manufacturers, the vendor sells the assets to the lessors, who in turn leases it to be the lessee. A lease agreement in which the lessor provides an equity portion, usually 20 to 30% of the lease asset cost, and the third party lenders provide the balance of the following. It is a special form of leasing which has become popular in the financing of big ticket assets such as aircraft, oil rigs, and railway equipments. In contrast to the two parties involved in a sale and the lease back or direct leasing, there are three parties involved in the leverage leasing: the lessee, the lessor, and the lender. So three parties are involved in the ledger lease contract. So manufacturer to selling asset to the lessor, leasing the lessee is leasing the assets. Okay, the lender is the lessee. From the standpoint of lessee, there is no difference between a leverage lease and any other type of the lease. The lessee contract to make periodic payment over the basic period and in return is entitled to use of the asset over the period of the time. The role of the lessor, however, it changed. The lessee acquires the asset in keeping with the term of the lessee agreement and the finance acquisition it in part by an equity investment of say 20%. The remaining 80% of the financing is provided by the long-term lender. Usually the loan is secured by the mortgage on the asset as well as by the assignment of the lease and the lease payments. Advantages of lease payment: saving of capital. Leasing covers the full cost of equipment used in the business by providing 100% finance. The lessee is not to provide or pay any margin money as there is no down payment. In the way, the saving in capital and financial resources can be used for other productive purposes, example purchase of inventories. Flexibility and convenience. The lease agreement can be tailor-made in respect of lease period and the lease rentals according to the convenience and the requirement of all lessee. Planning cash flows. Leasing enables the lessee to plan its cash flows properly. The rentals can be paid out of the cash coming into the business from the use of the same assets. Improvement in liquidity. Leasing enables the lessee to improve their liquidity positions by adopting the sales and leaseback techniques. Shifting of risks of obsolescence. The lessee can shift the risks upon leisure by acquiring the uses of the asset rather than the buying asset. Maintenance and specialized services. In case of special kind of lease agreement, lessee can avail specialized service of leisure for maintenance and of asset leased. Although lessor charges higher rentals for the providing such services, lessor's overall administrative and service costs are reduced because of specialized service of the lessor. Of the balance sheet financing, reasoning provides of the balance sheet financing for the lessee in that the lessee is recorded neither as an asset nor as a liability. So last advantages of the leasing finance to the lessor is the so till now whatever we have discussed the advantages of the leasing finance, that are the advantages of the leasing finance to the lessee. Now we are discussing the advantages of lease financing to the lessor. Higher profits. The lessor can get higher profits by leasing the asset. Tax benefits. The lessor being owner of an asset can claim various tax benefits such as depreciations. Quick returns. By leasing the asset, the lessor can get quick returns than investing in the project of the long gestations period. Disadvantages of lease financing to lessee. Higher cost. Lease rental include a margin for the lessor are also the cost of the risks of obsolescence, and it is the thus regarded as form of the financing at higher cost. Risks of being deprived the use of the asset in the case of leasing company wind up. No alteration in asset. Lessee cannot make changes in asset as per his requirement. Penalties on termination of lease. The lessee has to pay penalties in case he has to terminate the lease before expiry of lease period. Disadvantages of lease financing to lessor. High risk obsolescence. The lessor has to bear the risks of obsolescence as there are rapid technology changes. Price level changes in case of inflation. The prices of an asset rises but the lease rentals remain fixed. Long-term investment. Leasing requires the long-term investment in purchase of an assets and takes long time to cover the cost of that asset. So we have covered the advantages and disadvantages of leasing financing to the lessee and to the lessor. So now long-term debt versus the leasing. So let's discuss the difference between the long-term debt versus, and leasing. The leasing makes it easier to get the uses of the asset for less money. It sounds advantageous for the entrepreneurs who are not cashing rich, but if we take the long run view, we see that we will always have a payment to make but no ownership. In time of doing business, it is needed to be considered whether to choose lease financing or long term debt or loan to run business activities. Some differences are stated here considering long term debt and leasing. Down payment. While taking an asset on a lease, down payment is not required. Only a periodic lease rental payment is required, which is lower as compared to the percentage of down payment. Whereas in the case of a long-term loan, the borrower has to repay a small percentage in form of down payment at the beginning of the transactions and installment amount at the required time, and the balance amount is financed by the loan. The option of buying the asset. The lessee uses the asset up to the lease period and the pays the rental. He has the option of buying the asset at the end of the lease, whereas in the case of a long-term loan financing, it is compulsory for the user to buy an asset as soon as he gets the loan. Security, no security in any form is required for lease financing, whereas the borrowers needed to pledge his existing asset as a primary collateral security in case of a long-term loan. Presentation in financial statements. In lease, the value of the asset is not included in the financial statements, whereas in the case of a long-term loan financing, the asset appears on the asset side and the corresponding liability for loans appear on the liability side. Tax implications. In the case where the asset is purchased on the long-term loan, the user can claim interest on the loan payment and the depreciation of the asset. Whereas in the case of the lease financing, the users can claim only lease rentals which are uniform during the lease period. Cash flow. Since there is no purchase of an asset in lease financing, the cash flow is limited up to the lease rental. Whereas in the case of the long-term loan, the cash flow includes down payment, loan receipt, purchase of asset in an installment paid at the required time. Transfer of risks due to the asset devaluation. In the case of the lease financing, the ownership of an asset is not attached to the user, so the risk of asset devaluation is transferred to the lessor. Whereas in the case of a long-term loan financing, the user of the asset has to bear all the risks of the asset devaluation due to the change in technology. So here we are done with the unit 2, capital expenditure decision under the risk and uncertainty, that we have discussed in under the session 1. Lease financing and operating lease we have discussed in the last session, and now we have completed the single investor and the leverage lease. So we have discussed the lease financing in detail. Thank you. Best wishes.